The content in this podcast was relevant when published on February 17th, 2025. As environmental, social, and governance issues continue to dominate discussions across global financial markets, the conversation has become increasingly complex, caught between growing expectations and a cyclical backlash. In this context, can private markets lead as drivers of sustainable change? With their longer-term investment horizons, they can look beyond the short-term pressures that often define public markets. But how can private market players integrate ESG strategies with both financial and non-financial performance to meet their long-term objectives? Welcome to Crafting Capital, the podcast that takes you inside the rapidly evolving world of private markets. I'm Philippa Layton-Jones, Senior Vice President of Custom Content from the Wall Street Journal. Today, I'm joined by Laurent Bouvier, Global Head of ESG Advisory at UBS, and Therése Lennehag, Head of ESG Advisory for Europe, the Middle East and Africa. Therése and Laurent, thank you so much for joining me here today.
Well, thank you. It's a pleasure to be here.
Thanks for having us.
Laurent, let's start with a big picture question. Given the cyclical nature of ESG and the current challenges it presents, what makes private equity and other private market players so uniquely suited to lead in this space?
Yeah, first of all, Philippa, I think that it's impossible to have a discussion about ESG without acknowledging the backlash that's been experienced over the last few months. It is very real, and it is affecting all market participants, from issuing firms who sell securities to the market and investors who buy them. Now, let me ask you this. If sentiment has admittedly soured in the last few months, has the future really changed in reality? Have all sustainability issues disappeared from the horizon? Was it just all a bad dream? If that's not the case, then I'd argue that the present hasn't changed in reality. Because you see, in the financial markets, as everyone knows, the present value of an asset is driven by future expectations. So if the future doesn't change, the present in reality cannot change either. And so I think it's very important to differentiate sentiment from reality.
Right.
So imagine that you're considering acquiring a target as a executive in a private equity firm. You're about to spend probably $1 billion, maybe $2 billion, to make an acquisition of a company and leave that money in that company for probably 5 years. It's a huge deal. It's not like 50 or 100 million in an IPO. It is a huge investment over a long period of time. This is a career-defining moment. So you're there and you look at this business, and the first question you have to ask yourself is, what is the value, the expected value of that business when you'll sell it in 5 years from now? So it's interesting that the first thing you need to ask yourself is about the future value of the business, because it's only by discounting that future value that you'll figure out how much you can pay today. But that's just the first leg of the reasoning. If you want to think about the value of the business in 2030, in 5 years from now, you're going to have to think about what people will expect about the prospects of that business and investor preferences in 2035. So we are here in 2025. We want to make that big investment, and we are not going to be able to make a decision as to how to allocate our capital without asking ourselves what this business and what the world will look like in 2035.
Right.
And so we firmly believe that the world in 2035 will ascribe a bigger premium to sustainability as it does today, simply because we will be able to touch the sustainability issues with our fingers in a much more concrete fashion than we can do it today. And if you are that private equity officer who's making that investment, you're going to have to ask yourself, what element of sustainability do you need to embed in the way you manage that business, in its strategy, in its operation, so that you can maximize the value of that business in 2035. And so that is private equity by being forced to protect themselves into future transactions that will crystallize the value of the business, they have to consider sustainability. Now, there is that second notion about the differentiation between sentiment and reality.
Right.
And so what we've always expected in our team over the years is that the sentiment of ESG over time would fluctuate. And that's just in the nature of human beings. Sometimes you believe in it, sometimes you believe less in it, and that creates a cycle. But we shouldn't, again, confuse that sentiment with the reality, which is a lot more stable.
So, Therése, Laurent has just given us some excellent illustrations there of private equity's long-term view. What's your take on this? How does private equity's focus on long-term relationships and reputation influence ESG success?
Well, based on the logic that Laurent just outlined, over the last few years, many private equity firms have actually already built quite strong programs around these structural factors, ESG factors, as we've now been used to call them for a long period of time. And they've also actually been quite vocal about it. And something else, as you pointed out, that is critical to private equity is their reputation. It is the trust that they enjoy in the market. Because despite the private and private equity, PE firms and their professionals, they are far from faceless. Laurent alluded to it, but compared to many public investors, private equity investors are owners, they're shareholders, with a much greater personal presence and accountability. And they continuously meet with their counterparts, be it their clients, i.e. their limited partners, their portfolio companies, and of course also their advisors over long periods of time. So having a well-founded stance to these structural factors, I would even call them generational or universal issues, that stands the test of time and cycles. Yes, there is a difference between sentiment and reality, but at the end of the day, these are universal structural factors that also you need to take a view on over the cycles. And therefore, if you've already been vocal about it, of course, it's essential for maintaining that trust in the market that you stand by your word. And that is to protect both the individuals and the firm's reputations, which at the end of the day, absolutely critical to long-term success.
So you've both touched on there how the scope of ESG is changing, especially with private equity's emphasis on that long-term value creation. Therése, let me ask this of you. We've seen ESG evolve from being a competitive differentiator for private equity firms to becoming more of a baseline expectation. How have governance and social factors played into this shift?
I think a lot of people have been a bit deceived by the fact that environmental issues have potentially been dominating the headlines for the past decade. But for private equity, governance, the G in ESG, has always been at the core of their strategy and practices. In fact, I remember a few years ago, and it is probably more than 10 years ago now, but there was a prominent private equity firm across the Atlantic. They actually named and titled their annual sustainability report the GES report.
Right.
So in other words, starting with the G to really signal that to them, to private equity, governance is absolutely critical. And I think it goes back to that well-founded logic that at the end of the day, it's impossible to manage a factor that is critical to business success, be it an environmental or social factor, unless you have that governance, that appropriate governance framework in place. And then the other point I would make, which the market is aware of and have been aware of for some time, which is also why we're seeing this backlash towards the acronym of ESG. But actually the complexity, the wide scope, and the interconnectedness of these factors make it quite hard to categorize them all into three distinct boxes. And some lines have always been blurred, such as diversity, for example. Is that a governance issue or is it a social issue? But other issues, with new knowledge, we're increasingly recognizing that those lines are also being blurred, be it climate change or biodiversity or water usage. Are those three distinct things or actually all interconnected? And not only are they environmental issues that are deeply interconnected, but they're also deeply interconnected with human health and safety, with migration, and then, of course, the new hot topic in town, which is geopolitics. So we would argue that the sustainability business agenda is maturing. It is maturing beyond these very simplistic, broad brush ESG narratives to one where investors and corporates will need to clearly articulate what their focus is and how this non-financial focus, or as we also at times prefer to call it, pre-financial focus, how that links to financial value creation, both today in the present and then tomorrow in the future.
Well, Therése, you've mentioned some very important issues there. And it's hard to escape when we're talking about important issues like these, that ESG has become really a political lightning rod, particularly in markets like the US. Given the current polarization, how are private markets addressing these challenges and maintaining focus on long-term sustainability goals despite those political distractions?
Yeah, look, I think there's no doubt that politicians have exploited ESG and created a lot of confusion. And I don't think there's any way to go back. I think ESG has become toxic to the point of being set aside. But look, I'm going to tell you what ESG is about from our perspective in 3 points. And you're going to tell me whether this is anything else than best management practice and hardcore corporate finance, all right? So, look, the first thing you got to do, according to ESG principles, is to engage with your stakeholders, your employees, your customers, your suppliers, the government, and need to figure out what is important to them and what will maximize their contribution to the achievement of your strategic and operational objectives. Sounds like a pretty decent thing to do.
Sure.
On the basis of that interaction and considering your strategy, you'll identify 2 or 3 sustainability drivers that will impact the future performance of your business. I'll take a few examples here because it's not all about climate. If you are in real estate, you'll think very hard about energy efficiency. If you are in luxury goods, you'll think about employee training. If you do anything with plastics, you'll think about recycling. If you run hospitals, waste management is going to be a pretty big deal. And if you're in apparel, water is going to be very important to how you think about your operations. So once you've identified the sustainability drivers, you can ask yourself, to Therése's earlier point, how you measure your performance along these drivers. And you can ask yourself, how can you improve your operations, how you can de-risk them, or create opportunities with new products that would sell better in that future world that we talked about earlier on. You're going to look at the cost, you're going to look at the benefits, and you're going to ask yourself, how will this impact my cash flows, and how will that maximize my cash flow? So that's what ESG is about. It's about broadening your horizon to go beyond the short-term financial metrics and consider non-financial, pre-financial metric that will drive the future success of your business. And private equity indeed has the opportunity, with a cool head, in a very rational fashion, and the focus that these guys have, to really think about making the right decisions that will maximize value for their businesses in this scenario that we discussed early on in 2030, in 2035, away from public scrutiny.
Okay, so sound decisions, sound business management, and cool heads. Therése, can I ask you for your take on that?
I hate to disappoint, but I actually fully agree with with Laurent. ESG in private markets, it isn't about aligning with one political perspective. It is about finding and financing and really delivering those solutions that we want and know that society needs over time. For private equity executives, it is about building better businesses and also a stronger society, actually, because by focusing both on what you invest in and then how you actively, to the point earlier about governance, how you actively govern these businesses, that is what will secure your ability to generate attractive IRRs over time, including political cycles.
So with all the complexity surrounding ESG that we've been discussing, transparency has become more crucial than ever, particularly as the lack of it has often been called out as a key challenge. How are private markets adapting to the increasing demands for transparency? Laurent, let me start with you on that.
I think transparency requires investments because we now have that broader horizon. We need to measure things that we never really measured in the past or didn't pay attention in the past, or measured but in a non-reliable manner. And so now we need to up our game. Management teams have to up their game. And there's a lot of new technology with sensors and measurement devices and things that can be done in order to help them assess their non-financial performance. But we'd simply argue that to the extent that they don't get lost into the immaterial world and focus on what really drives their business and measure what will drive their business, this investment of time, this technological investment, this CapEx, and we recognize this comes at a cost, will yield significant benefits. And to the point made earlier, we do think that those who implement the right operating system, the right business systems, will create a competitive advantage for themselves. So there again, private equity has a chance to really think carefully about that and think about the portfolio of sustainability initiatives that it can then implement. I want to say something here because, there is often the notion that because we don't know what the world's going to be in 2030, 35, temperature rises, water use, etc., it's very difficult to make decisions. This is nonsense. Corporates in the world spend $1.2 trillion every year in R&D. Do not tell me for a second that they know exactly what they're doing and that at any point in time, the products that they're making are, for year 2030, year 2035, and they already know what the macroeconomic conditions are going to be there, what customer preferences will be there, and what the regulatory environment will be there. They have no idea. And yet, they are spending a lot of money because they are making bets within the portfolio of initiatives around innovation, and they've developed the conviction that this was money well spent. The only thing we're suggesting today is that you do the same thing with sustainability initiatives. You apply the same logic to sustainability initiatives. Some projects will have a short-term payback. Some of them will have a long-term payback. But the fact that we don't know about the future is no excuse for not making decisions. And there again, we think that it's much easier to make that point and to sell that point to investors when you are the investor yourself, right, when you are the shareholder, when you're a private equity firm.
Well, Therése, I'm really interested in your perspective on this as well, because the EU private markets are held to the same standards as public markets. How are private equity firms adapting their ESG strategies to meet these growing transparency concerns?
Well, you're absolutely right, Philippa, in the sense that EU regulations have indeed, over the past 5 years, pushed private equity firms even further when it comes to disclosure practices, and especially with the advent of the EU Sustainable Finance Disclosure Regulation. But I would again argue that many prominent private equity firms actually started their transparency journeys several years ago because they obviously saw the business need to navigate these sustainability challenges ahead. And where they started off was with common sense in terms of what is actually material for these individual portfolio companies, be it innovation, as Laurent just discussed, or be it resource efficiency, because we're seeing those planetary boundaries increasingly shrinking upon us, or diversity. But I think what this proactive approach has also allowed them to do is to some extent appreciate the systemic nature of these challenges. And that is also to some extent what the new regulations are about, right? To really try to further the broader market and therefore further some standardization across these data points. And it has allowed these private equity firms to really align society's long-term sustainability goals, not only with the business strategies and the practices of the individual portfolio companies, but ultimately also the needs of their clients, their limited partners. And these limited partners, they're very often universal owners and fiduciaries of financial returns spanning generations. So what they recognize is that these investors are not only in need of the financial returns today, but they are also in need of better societal outcomes to secure those financial returns tomorrow.
Everything we've talked about here points to the fact that ESG is really poised to play an even bigger role in private markets. But no great transformation comes without challenges, of course. Therése, staying with you for a moment, what do you see as the biggest hurdles ahead and the biggest opportunities for ESG, say, over the next decade?
I think we've touched upon it now. And frankly, I think one of the biggest hurdles, and therefore also one of the biggest opportunities, is how we approach this ESG data or non-financial data. The greatest risk that we have today is that we're treating it merely as a compliance exercise rather than leveraging it as a source of strategic insight and innovation. So to truly unlock its potential, I think there needs to be a bit of a mental mind shift for certain parties in the market. And I think we need to really make sure that ESG data revolutionize finance in the same way that X-rays revolutionized medicine.
So, Laurent, a mindset shift there, as mentioned by Therése. Same question to you. Do you agree? Are you optimistic about ESG's future in private markets?
First, I totally agree with Therése. Look, I think at the end of the day, there's a new world out there. It requires all of us to be a lot smarter. And what seemed to be a simple world, perhaps in the 80s, appears to be a much more complicated world today with a lot more data. That is the opportunity for new pioneers. People will make mistakes because there is a new world. Some of these ESG initiatives, sustainability initiatives, could miserably fail. But the smart ones will be able to construct a portfolio that ultimately should drive profitability, growth, and ultimately value creation. But it's going to be tough. I think we all have to make a pretty big investment. It's not just money, it's also a mental investment. We also have to do a lot of learning in order to be able to cope with that new world and build this competitive advantage. We have no doubt in the team that private equity is extremely well positioned to seize the opportunities related to this situation.
So, Laurent and Therése, what we've heard today is that reading the cycle, taking that long-term view, blocking the noise and leaning into the complexity is a route to exceptional opportunity. Your insights today have been invaluable. Thank you so much for being here. Laurent, Therése, thank you.
Thank you.
Thank you again for having us.
As the investment landscape continues to change, I'm sure this conversation will serve as a great reminder of what can be achieved by private market players in the years ahead. You've been listening to Crafting Capital, a podcast series in partnership with custom content from the Wall Street Journal and UBS. And I've been your host, Philippa Leighton-Jones. Join us for more episodes at partners.wsj.com/UBS and on Spotify and Apple Podcasts.